With the US tech stocks growing at an enormous rate year over year, reaching multiples never seen before, it has become increasingly hard to find opportunities as a value investor. But what if I was to tell you that the company Alibaba, based on the other side of the globe, might be a huge value play trading below every reasonable valuation, doing the same thing as some of the US tech giants? Today we are going to find out if there's actually more to the current price of Alibaba and whether now is the time to buy the stock. This is Might As Well Invest, becoming smart money. On a quick side note, the YouTube algorithm has recently stopped pushing my videos. So if you want to help me out with no additional cost whatsoever, I would appreciate it if you could smash the like button, drop a sub, or maybe even share your take on Alibaba down in the comments below. Alibaba, which was founded in 1999, is one of the leading e-commerce players across the globe, and yet only boasts a market cap of $573.2 billion US dollars. But obviously that is still quite sizable for a company that actually pretty much only operates in one single country. That market, however, is China and contributes a big chunk to the overall revenue of about 71.9 billion US dollars. However, as per usual, let's take a look at that exact revenue to figure out what may drive Alibaba going forward. Their biggest and most notable segment is, as one could think, the e-commerce segment, contributing 61.5 billion to the overall revenue. This is then followed by the cloud computing segment, which contributes another 5.6 billion. Coming in the third place, we then have the digital media segment, which contributes another 3.8 billion. And last but not least, we then still have the innovation segment, contributing the missing 0.9 billion to the overall revenue. But enough with the brief introduction. Let's get to the interesting part for all of those who already are shareholders of Alibaba or that are planning on becoming such, and that are the distributions to shareholders. At the current point of time, Alibaba, however, does not return capital to their shareholders in any shape or form. However, it has to be said that in the previous years they sometimes spent a little bit on stock buybacks, which were, however, also pretty inconsistent and not really significant. Let's, however, still take a look at Alibaba's free cash flow though, as this is pretty relevant when it comes to further investments in the company and also distributions later on. So if we put these into contrast with the distributions, which is what we usually do, we can see that just the stock buybacks are highly sustainable. What, however, is in my opinion even more noteworthy is that Alibaba's free cash flow is growing at an amazing pace. That leads me to believe that this company is going to become a true cash flow monster, obviously allowing them to invest in new ventures, the company itself, and, probably most importantly, dividends. However, free cash flow growth isn't everything when it comes to the success of a company, for which reason we are going to dig a little deeper into the finances of Alibaba, which we are going to do by taking a look at the balance sheet. As per usual, let's start out with the year of 2016, in which Alibaba's total assets sat at about 56.5 billion US dollars. These were made up by about 38.7 billion in equity, 8.9 billion in financial debt, and 8.9 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is done using Alibaba's debt and its cash position of about 16.5 billion, with which we get a net debt of about 0 billion, which is pretty damn good. If we now compare this to the year of 2020, we can see an increase in total assets that is quite staggering, to be honest, to about 185.4 billion US dollars. These were now made up by about 122.9 billion in equity, 18.1 billion in financial debt, and 44.4 billion in non-interest paying capital. Let's, however, again calculate the net debt, just like we did for the year of 2016, with this year's cash position of 46.6 billion. This time we again, surprise, get a net debt of about 0. At this point we would now usually figure out how sustainable the debt of the company we are analyzing actually is using the EBITDA. Since there, however, is no debt, or more so net debt for the case of Alibaba, we can simply skip that part, which is a really good sign. Alright, so since we now have the financials covered, what we want to do is get the margin of safety, as this will help us with getting the fair price per share for Alibaba. First of all, and to start out, Alibaba is in a magnificent position when it comes to their financials. Trust me, I don't say that lightly as a person that puts a rather high emphasis on smart and thought out financial management in companies. But the scale of growth Alibaba was able to achieve without really using almost any leverage is tremendous. Sure, they use debt, which is perfectly fine, but a net debt of about zero is something you rarely see, and especially combined with such high growth. And if this should continue, I'm also quite sure it will open even more doors for Alibaba than the ones that are already open at the moment. Therefore, I will be reducing my margin of safety by about 5%. However, as I've already said, Alibaba, which many call the Amazon of China, has already opened countless of doors for themselves, to the point where they are actually starting to become more than just e-commerce. You have already heard it at the start of the video, but Alibaba includes various segments such as cloud computing and, for example, streaming, which is both very Amazon-like. The probably most significant segment, or more so subsidiary in my opinion, is however Ant Group. While Ant Group has had their fair share of not so awesome news, I still think this company is a huge opportunity for Alibaba, as it not only is the biggest mobile payment processor, but also boasts a huge money market fund under its name. And trust me, that is just an example of the successful brands under the wings of Alibaba, as the company's e-commerce venture is the backbone driving huge cash flows to Alibaba's venture funding programs, that in parts of Asia engage in a state of duopoly with Tencent when it comes to funding new companies. Therefore, I will be reducing my margin of safety by another 15%. However, Alibaba does also provide some downsides. Let's start out with a minor one that however has the possibility to become a bigger factor in the future. And that is that as of today, Alibaba is no longer the leader when it comes to growth in the Chinese e-commerce market. Sure, this is nothing new, as the bigger a company gets, the harder it is to get growth going for themselves. It however has to be said that in a market which is getting more and more established, the danger of companies such as Pinduoduo, I'd like to imagine I pronounced that right, eating away market share from Alibaba is becoming more likely. Therefore, just as a measure of caution, I will be adding 5% to my margin of safety to be on the safer end of the spectrum. In addition to that, in my opinion, and most significantly, I however also want to add that there is a certain market risk, especially to Chinese companies. Alibaba and their CEO are actually one of the prime examples highlighting the fact that the economy is run as per wish of the state, which can result in possible threats to that system simply disappearing. While I'm in no shape or form trying to get political with this, I'm simply saying this is something to look out for. Because in a case like this, I would much prefer if a government was on the side of my company, nurturing it to immense success. If that treatment should however no longer apply, this could turn into a downside that makes business a ton harder. Therefore, as a measure of precaution, I will be adding 10% to my margin of safety. Usually on this channel, we would now value a company using the dividend discount model. Since Alibaba, however, does not pay a dividend, this is not exactly possible, for which reason we are instead going to use another common form of analysis called the discounted free cash flow model. For this, I'm going to assume a growth stage of about 10 years with an average growth rate of 13%, which I personally assume to be quite reasonable, especially since I think the main segment of Alibaba, like e-commerce and cloud, have quite some room to grow in the future. After that growth stage, I'm assuming a terminal growth rate of about 6% for 12-ish years. This would then translate into a fair price of about $272.86, which would mean with the current share price of $217.75, we would be getting a 20.2% discount. If we now want to figure out the price I would be willing to pay, we would simply have to add the safety margin to the fair price which we calculated before. With my designated safety margin of 20%, this would then translate into a price to buy the company at of about $218.29, so basically right above the current price. To sum it all up, it has to be said that Alibaba to me personally seems like a very well-rounded company that is positioned very well for future growth and long-term success. Sure, investors face some risk, which we discussed in the safety margin part of this video. However, all in all, I honestly have to say that an investment in Alibaba basically gets you the same thing as if you were invested in Amazon, and that obviously at a far lower multiple, which is always nice. Therefore, I currently think the upside outweighs the possible risk out there, for which reason I will be rating Alibaba an absolute buy.